With that said, I'll turn it over to you.
Sounds great. Thanks, Eric. Just to make sure, I want everybody to be able to see my screen. If for some reason you can't see my screen, please type a message in the question bar and let Eric know. But I'm very, very excited to be on today's webinar and sharing some very valuable information. As Eric mentioned, I am an equity broker. I'm an associate broker. I'm located right in the corporate office. I've been with Equity now for over 2 years, and it's been the best thing that I ever did for my business. And the things that I'm going to share with you today are things that I actually implemented in my business over 3.5 years ago, and they've really helped take my business to the next level. Before we get started today, I'm hoping that everybody on today's webinar has read the book entitled Who Moved My Cheese? And if you haven't read that book, it's a very quick, simple read. Just pop by a bookstore or jump on Amazon or Barnes & Noble or download it on your Kindle or your Nook and just simply read the book, Who Moved My Cheese? Because our current market and our current economy, the cheese is moving, and it's moving again, and it's moving faster than it's ever moved before. And if like in the book, if we don't move with the cheese, then we end up starving to death. I know that right now we're seeing the cheese move dramatically in the mortgage industry. And in fact, I was talking with an underwriter yesterday, and their opinion was that the refinance market is dead. It's like the refinance market's completely gone away because interest rates have gone up. So their cheese has moved. Now, if those individuals don't move with it, they're going to be left to starve. So with that being said, we're going to jump right in. I'm going to cover a lot of things today, so if you can, have a pen and a piece of paper handy, take some good notes. I did talk with Eric. We are going to email out a copy of this presentation to everybody that's on today's webinar, so you don't have to write down everything that's on every single slide, but you will definitely get a copy. So let's jump right in. One thing that I want to share with you today is our VIP Seller Recovery Program. And this really comes down to when you're working with your short sale sellers. And we will talk a little bit about buyers today, but our webinar is really about how to turn a short sale seller back into a buyer, because we want everybody to not only get one paycheck when they list and sell a home, but we want to take these individuals that are selling in short sales, and we want to get them back into the market and back into home ownership as fast as possible, because that's our pipeline. I know as a real estate agent myself, I didn't want my seller selling a home and then being out of the market for 5, 7, or 10 years. Because think about it, if you have a client right now that's a short sale listing, if that property goes to foreclosure, they might not be able to buy another home for 7 to 10 years. Well, for some of us that are on today's webinar, we may actually be retired by then. So they may never, ever be our client again. And with the program that I'm going to share with you today, we've actually taken sellers that have sold their short sale property and put them in another home the very next day, or the very next week, or the very next month, and received 2 checks again instead of 1. So I'm going to share that with you. I'm also going to share with you a portfolio loan today that is available in almost every state that every individual on the webinar today is located in, where a person can actually get a new loan one day after the short sale takes place. But before we get into that, let's talk a little bit about our recovery program. And this is where a lot of real estate agents really miss the boat. When they're sitting down at their initial listing appointment, they don't really want to talk with the seller about what's going to happen after the short sale takes place. And the reason why is sometimes there's just too much pain for the seller, or it's an uncomfortable situation. I'm sure that there's quite a few agents on today's webinar that have probably sold another home to a buyer that had recently sold as a short seller and didn't use that same agent. And part of the reason why they didn't use that same agent is that same agent didn't ask them to purchase another home, and they just thought, you know what, this is a short sale, we're one and done. And we're going to really hopefully change your thinking today. And so in doing that, when we're sitting down with our short sale sellers, we're asking them the critical questions. You are moving. When your home sells, where are you going? What are your intentions? And oftentimes their current financial state does not allow them to do very many things. We've had people actually sell as a short sale and not even be able to go out and afford to rent. They've had to move in with friends or family members. And so we look for every way possible to get individuals back on their feet. We had a single mom. She was a nurse at our local hospital, 3 kids, and she was paying $1,700 per month in credit card payments. So we sold the home as a short sale. She couldn't even afford to go out and rent because she was paying all these credit cards. Well, we simply put her in a credit counseling service program, and they were able to renegotiate and restructure her credit card debt, and she went from paying $1,700 a month to paying under $500 a month. So that freed up enough money for her to actually go out and rent an apartment for her and her kids. Now, she also had some student loans because she was a nurse and she'd gone through school. We were able to also work with a company that renegotiates student loans. So that also lowered some of her student loan debt, allowing her to qualify for more home when she could repurchase, and at the same time created more monthly cash flow for her. So in that scenario, that client simply had to stay in that recovery program for almost a 14 to 16 month period of time. But that's still much better than having her out of the marketplace for 5 to 7 years. Now, we do talk with our clients about bankruptcy because bankruptcy definitely has its place in the marketplace. And the bankruptcy laws were created for a reason, and that's debt relief. And especially if you're doing a short sale, and let's say the second note is Key Bank, and Key Bank is notorious for not releasing their second. They'll release their lien, but not their deficiency. They'll want to collect that from the client. So oftentimes the client follows through with the short sale, and then they have junior lien holders or other creditors coming after them for additional debt. Well, at that point in time, a bankruptcy is still a valid option. And with the current FHA guidelines, an individual can requalify to purchase in as little as 2 years and 1 day from the date of discharge from the bankruptcy. So we're still keeping these individuals in our pipeline. Now, the interesting thing about bankruptcies, and I just want to mention this, is once a person files bankruptcy, that's when all of the reporting stops. So oftentimes, even though it's been 2 years and 1 day from the date of discharge, people will go back and pull their credit to qualify for a loan, and they'll find out that everything that was included in their bankruptcy is still showing open and past due on their credit. So if an individual hasn't taken care of those items, they're going to have to go back and get those items fixed on their credit so that they can qualify for their home loan. And of course, we're going to talk a little bit about credit restoration today. Credit restoration does work. There are a lot of scams out in the marketplace. We're going to show you what to look for so that your clients can avoid those scams. And we do have a website here on the screen. It's www.ucesinfo.org. Wait until the webinar is over to go visit that website, and there's going to be a video there that's going to explain the credit restoration services that are available for your clients, so you can pass that information along to them. Now, it looks like we just had a few more people join us today, so I did want to just mention to those individuals, not only take great notes, but we are going to email out a copy of this presentation to everybody that's on today's webinar, so you don't have to write down everything that's on the screen.
Randy, let me interrupt you really quickly, if I may.
Oh, you bet.
Somebody has typed in and said, are you saying we can remove bankruptcies from credit reports?
That's a great question, and yes, you can. In fact, we're going to address that here on one of the very next slides. We're going to talk about the 10 biggest myths about credit. So we will definitely address that. But before we do that, let me talk about IDAs. Now, IDAs stand for an Individual Development Account. And you can go to cfed.org and type in your city, and it's going to show you a list of all the nonprofit organizations in your local marketplace that have an IDA program available for your clients. Now, IDAs are for lower income individuals. However, lower income individuals still buy a lot of homes. And so the way the IDA program works, and incidentally, the nurse that we were talking about with the 3 kids we helped get back into home ownership, she used an IDA program in order to do that. And the IDA program, the way that works is your client will go to the nonprofit, they'll fill out their paperwork, because again there is an income qualifier. Once they determine that they're eligible, they will open up a savings account with the nonprofit. Once that savings account is open, over a period of time, typically 24 to 36 months, sometimes it goes a little quicker than that, each individual, when they deposit $1 in their savings account, it gets matched with up to $3 of federal and donated funds. So over a very short period of time, these individuals can save up to $6,000 for one of three things. The first thing that they can save it up for is to go back to school. So they could take that $6,000 and apply it as tuition. The second thing that they can do is they can actually open up a business with the money. And then lastly, the third thing that they can do is they can use it for a down payment on a home to get back into home ownership. Now the nice part about that is that includes seller finance transactions. So maybe you have a potential buyer that still may not credit qualify for one reason or another. Maybe they're self-employed, for example. They could still use that money to purchase a home through a land contract or a contract for deed. And make sure you don't confuse those two with a land trust, because a land trust would definitely not qualify and something that you probably want to avoid. Or you could do an all-inclusive trust deed or a trust deed and note with those funds as a down payment. So that's a phenomenal program to maybe bring some of your past sellers back into the marketplace. So you go back to them and say, hey, I learned about this phenomenal program in our local market area. Here's the nonprofit that we can go work with. Most of these nonprofits are also HUD counseling agencies, and so if they do need some credit counseling, they can also get that counseling through that nonprofit as well. Now, before we jump into the 10 biggest myths about credit, I just want to plant a little seed in your mind, because I want everybody thinking open-minded. And what I have here on the screen is a unique value proposition. And this is one of the things that I've been saying to my potential home buyers and my short sale sellers for over 3 years. And the first thing that I say to my home buyers is, buy your home with me and we'll fix your credit for free. And I'm sure that I'm sure most of us on this webinar have had that phone call where a home buyer is called off your sign and said, how much is this home? And before you get into that, you simply say the magic questions. You know, are you working with an agent? And the answer is hopefully no. And then the second question is typically, have you been pre-qualified for your lending? And at that point in time, that's where the long silence on the phone comes in. So we know at that point in time that that potential home buyer probably has an issue. And most real estate agents simply say, well, tell me what's going on. And the home buyer says, well, the potential home buyer says, well, my credit score is a 550. And the agent goes, well, you know, you need a 640 to qualify for FHA. When your score comes up, call me back, click. Well, instead of doing that, all we've been saying for the last 3 years is, no problem, we have a program for that. When can you meet me at my office? And of course, between the time that they meet with me at my office, our mortgage lending partner is going to call them and get them pre-qualified, and we're going to find out exactly what we're dealing with. But it's a message that really nobody else is typically saying in the marketplace. Also, sell your home with me and we'll fix your credit for free. When I'm competing for a short sale listing, we just had an agent competing for a $500,000 short sale. They were interviewing 4 or 5 agents, and when the agent simply went on the listing appointment, they just said, you know what, sell your short sale with me, we'll fix your credit for free. And of course, after the short sale took place, everybody closed. The seller was enrolled in the recovery program, and they're getting back on the road to home ownership because that agent knows, one, they needed a competitive edge to win the listing, and then 2, they want to get this individual back to the point where they can qualify to buy another home from them. And of course, it might not be the $500,000 home that they just sold, but it could typically be, or possibly be, a $250,000 or $300,000 home. So just kind of keep that unique value proposition in mind. So let's jump into the 10 biggest myths about credit. And as Eric mentioned, I've been a real estate broker for 13 years. I was also a mortgage broker for 10 years and owned a very large mortgage company. And so I thought I knew a lot about credit. Prior to that, I was also in automotive finance for about 12 years. And so I was very confident when it came to credit, but once I started really learning a lot about credit, I realized how much I really didn't know. And so we're going to dispel all those myths today that are out there. So myth number one is credit agencies are empowered with some type of governmental authority. And credit agencies actually have no legal authority at all. They're actually privately held billion-dollar companies who are just in the business of basically digging up dirt on everybody in America and then selling that information to companies that determine whether or not they're going to grant an individual credit. Myth number two, the credit agencies are required by law to keep derogatory items on your credit report for 7 to 10 years. And in reality, there's no law that actually says that the credit agencies can report anything on you at all. In fact, it's just the opposite. Credit agencies are required by law to automatically remove all derogatory items older than 7 years, or in the case of a bankruptcy, 10 years. Now, the interesting thing about this is the credit reporting agencies, there's so much information that there isn't anybody sitting in a cubicle, which by the way probably isn't even in our country, looking at the clock on the wall that says, gee, Mr. and Mrs. Smith's bankruptcy is 10 years old today at 3:26 p.m. I think I'm going to log into the system and remove that. That really doesn't happen. In fact, I have a client right now in our program that we're working on getting qualified to buy a home. His bankruptcy is actually 12 years old and still being reported on his credit. Now that's very easy to get removed because it's way beyond the statute, but if that individual doesn't do anything about it, then nothing's going to happen. Myth number three, it's impossible to get a bankruptcy off, and this was the question that came up. And a bankruptcy can come off just like any other derogatory that's being incorrectly reported, that's obsolete, that's erroneous, misleading, incomplete, or that cannot be verified. And that's a key word, verified. Remember, the nature of an item on a person's credit report has nothing to do with its removal under the Fair Credit Reporting Act. Currently, we have a client that's in an open Chapter 13 bankruptcy. They've been in that bankruptcy now for over 18 months. They have approval from the bankruptcy trustee to go out and buy a home because they've been in their program more than 12 months. But when they went to credit qualify with the preferred lending partner, there were things that were supposed to be included in their bankruptcy that were still showing open and past due on their credit. So in the process of getting those to show that they were just simply included in the bankruptcy, 2 of the open Chapter 13 bankruptcies have actually already been removed from that individual's credit report. Now, this individual still has to disclose to the loan officer and the mortgage lender that they've had a bankruptcy, because that's a question on the loan application of the 1003, but it's no longer affecting their credit score, and it's resulting in a much higher credit score than that individual would typically have.
Randy?
So, yes?
Couple questions that have come in, if I may interrupt right now.
Sure.
How about a bankruptcy that was dismissed?
Bankruptcy that was dismissed, whether it was dismissed, discharged, it's not going to make any difference. In fact, it may actually be a little easier to get a dismissed bankruptcy off, because oftentimes those are reported incorrectly. Also, a bankruptcy, there's certain items that only get reported one time. So bankruptcies, foreclosures, final short sale, judgment, tax liens, typically those items get reported one time. The only time a bankruptcy ever gets reported more than once is if it's Chapter 13. It'll get reported at the time of the filing, and it'll get reported at the time that it either discharges or dismisses. Okay. But I will say, it's not any more difficult to get a bankruptcy removed from credit than maybe, say, a late payment on an automobile.
Okay. So a follow-up question from another agent was, even if the bankruptcy has not been 7 to 10 years, can you remove it from the credit report, and how soon could you remove it? Is it just a question then of looking for inaccuracies to get it removed, or?
It's simply a process. Credit restoration is a process very similar to a short sale, a loan modification, or getting a new mortgage loan. And as you'll learn here shortly, you can open an investigation or request a verification of anything on your credit report. And when that happens, there's certain things that have to take place. And if those items don't take place in the correct order and in the correct time frame, even if the thing or the item on a person's credit report is being reported correctly, it still may be deleted, even if it's prior to the statute. And in fact, I had a client last year in January that had some medical bills that were showing up as collections on their credit. They had been through a bankruptcy and those items were included, and in disputing, even though their bankruptcy was less than 24 months old, their bankruptcy came off all 3 credit reports within 60 days.
Great. Okay, thank you. Back to you.
Okay, myth number 4, the information on your credit report cannot be changed. And this kind of goes back to that question. The opposite is true under the Fair Credit Reporting Act. Both federal and various state laws require that items be removed if they're not 100% accurate or cannot be verified in a timely manner. And what happens when a person disputes items on their credit report, or a company disputes items on a person's credit report? The credit reporting agencies reach out to that creditor, and if that creditor doesn't respond within 30 days, even if that item is correct, it's still going to be removed from the credit report. Myth number 5, it's illegal or immoral to have the information on your credit report altered or removed. Not only is it not illegal or immoral, but it's exactly what the Fair Credit Reporting Act is all about. The Fair Credit Reporting Act was enacted by Congress for the very purpose of protecting consumers from the intrusion of credit agencies into our lives. And as I mentioned, their job is to go out and dig up as much dirt on us as possible. I did not give a credit reporting agency permission to access my information from anywhere. So with that being said, I have a legal right to dispute anything that they post and sell that has anything to do with me as an individual. Myth number 6, paying a past due debt removes it from your credit report. Just because you pay an old debt does not change or erase the fact that at one time you were not paying on it as you agreed. And the record can be changed. What typically happens is once the debt's charged off, or once something gets included in a bankruptcy, or once a home is sold as a short sale, for example, that's when the creditor no longer makes any money. And so creditors really don't want to spend any time reporting anything or taking any action if there's no profit in it for them. And so oftentimes when the reporting ends, it just ends. So you could have somebody that for example, we have a client that was doing a short sale on their property, and they had a closing date scheduled. They went out to rent an apartment, and when the apartment complex pulled their credit, the creditor that they were doing their short sale with had already reported their short sale on their credit as a foreclosure. Well, it's obvious we're still doing a short sale and a transaction hasn't even closed yet, but yet because it was reported as a foreclosure on their credit, it was prohibiting them from renting an apartment. And so that's something that we can easily go in and challenge to get showed so that we can get it to show either paid as agreed or deleted. Myth number 7. Inquiries are not derogatory and will not affect your credit standing. Now, a derogatory is much different from an inquiry. Inquiries are, let's say that you're thinking about buying a home, so you go to your mortgage lender and they pull your credit, and then you really didn't like the terms and conditions from that lender. Maybe they worked with a new home builder, so you went to another mortgage company that the agent referred you to, and they pulled your credit too. Well, that tells a little history about a person, and a couple inquiries from a couple mortgage companies or a couple auto dealerships, if you're shopping for a car, are really no big deal. But what really alerts a creditor is when they see a mortgage loan, they see a mortgage company, they see an auto dealer, they see a boat dealer, they see Best Buy Electronics, they see the ATV dealer. They start to see all these inquiries from all these different types of loans, credit card companies, and then they start thinking, well, if everybody grants credit and this individual gets all this credit and they use all this credit, are they going to be able to afford to pay me back? So a lot of inquiries for various different things can definitely affect your score. Now, an inquiry does affect your credit score typically anywhere between 2 and 4 points. So that's something to keep in mind. We had a home buyer last year that applied for a mortgage loan online with a company that simply sold their lead to 20 or so various other mortgage companies that all pulled their credit. Well, their credit score plummeted to the point where they couldn't even qualify for a mortgage loan because of the number of inquiries that had just hit their credit. So myth number 8, if you get a derogatory item removed, it will just come back. Now, if the item is removed legally, when it's removed with cause and under the Fair Credit Reporting Act, it cannot legally be placed back on your credit report. So the same law that required its removal prohibits it from being placed back on credit. Now, this is a very common question that we get, and about the only time that we see things go back on credit are, for the most part, collections. Because let's say that an individual had a collection on their credit, and through the credit restoration process, that collection was removed completely. Well, if that collection agency sells that collection to another collection company, that new collection company could possibly re-report the collection. Now, there are also individuals out there that unfortunately we call repeat offenders. We had an individual about 2 years ago that they were showing a rolling 30-day late 13 times on their truck payment with their credit union, when in reality that individual had only been late 1 time. And so going through the credit restoration process, that account actually came back, paid as agreed on all 3 credit reports, person bought a home. About 8 months later, that same individual called us back and said, well, I made my truck payment late again. I need to enroll back in your program. So it's unfortunate, but there are some individuals out there that are born with that gene that says I never pay anybody on time. And in reality, there are individuals out there that even though we don't like to hear it, should not be homeowners. So you know, this program isn't for everybody. Myth number 9, a debt collector can call you repeatedly at work, threaten to sue you, take your house, or put you in jail if you don't pay up on old credit card bills. And debt collectors are regulated the same way that the credit reporting agencies are regulated, but it's just by a different act. And each individual really needs to know their rights under the Fair Debt Collection Practices Act, especially if they're going through a short sale, for example, because once they enter that default process, all of those companies get very, very aggressive. I had a client that I was talking to this past week that there was a violation of the Fair Debt Collection Practices Act because of fraud. Somebody had gone to an electronics store and bought a $2,300 TV in their name, and they had a judgment hit their credit that they didn't even know about until they went to buy a car. Well, when they contacted this electronics store, they found out that they were being sued for the $2,300 because it had been charged on a fraudulent account that was open in their name with no signature. They still ended up going to court and settling for $1,800 out of their pocket, even though that there was fraud involved. Now, had they followed the Fair Debt Collection Practices Act, and had they known their rights before they got to that position, they probably wouldn't have had to pay that debt. So how can a person protect themselves? They need to do so in writing, and they do that by using what's called a validation of debt letter. And the nice part about validation of debt letters is they also stop collection calls. So debt validation letters need to be sent by certified mail within 30 days of the initial contact from the creditor or the collector, and then at that point in time all collection calls will cease and all of the letters the collections stop until the debt is verified by the creditor, and then they're simply going to respond to that potential collection or borrower in writing. And finally, myth number 10, I can't restore my credit on my own. And the answer is yes, you can. And this is a very common question that comes up. It's also a statement that I hear all the time. I had somebody tell me this just yesterday. Well, can't I just write a letter and send it in to the credit reporting agency? I said, absolutely. But you can also represent yourself in a court of law just like an attorney. And that's the example that we're using here. But as real estate agents, people can go sell their home for sale by owner. But as real estate professionals, we all know that homeowners need us more than they need themselves, because history says and proves that as a fact we typically get more money for the home, and we also protect the owner's legal liability. And typically what happens when people try and restore their credit on their own, they send into their letters to the credit reporting agencies, and really, one, they don't know what to put in their letter. And once they get a response, and let's say they get a response from the credit reporting agency that says, yeah, this debt's valid, well, at that point in time, they don't know how to respond and go back and re-challenge what's currently on their credit. So individuals could definitely do it on their own, but just like if they were going to sell their home, they would want to hire a professional to do it for them. Ironically, I have a client enrolled in our restoration program right now that actually works for one of the 3 credit reporting agencies as their full-time employment. So they see the value in our service by using a third party to leverage that Fair Credit Reporting Act. So before we move into really how to get your client back on the road to recovery so that we can move them from that short sale seller back into a home buyer, I just want to touch base on some of the realities that are really happening in today's marketplace. Lots of people have lost their jobs or taken a cut in pay. The industry that we're in, we all know that tons of people have lost their homes. Now, fortunately, there's a lot of individuals out there that have also done loan modifications and stayed in their homes, but still have challenges. The nice part about that is with the market coming back, many of those people now are in a position where they can sell as an equity seller, but they've had some bumps in the road along the way. And many people have lost their savings and investments. We recently closed a short sale transaction where the person had depleted their whole 401k that they'd built up over a 35-year period of time. They were just getting ready to retire with the company that they've been with. They've been there forever, and they depleted it to try and save their home. And at the end of the day, they lost everything that was in their 401k, and they still ended up having to sell the home. So we've all heard the term that bad things happen to good people, and that's true. There's a lot of great people out there that have had some bad stuff happen to them. Currently, 58% of the population does not pay their credit card balances in full each month. And if you're doing a lot of short sales, I'm sure that you've seen some of those charged off credit card accounts get posted on title policies. Unfortunately, we have to deal with those on a weekly basis. The average U.S. credit card debt's over $17,000, and those with more than $20,000 in credit card debt are likely to miss payments, see interest rates skyrocket, and credit scores plummet. So today your credit score is like a vital sign. It's being monitored at all times. And most people really don't know what's on their credit, and we're going to show you today how you can find out exactly what's on your credit. But about 25% of the population has a 599 credit score below, and that's about 43 million people, and that's our marketplace. In fact, there's an interesting article that was in USA Today on April 7th of 2013, and it's entitled "Mortgage Hassles Frustrating You." And if you want to go to USA Today and look this up, it's a pretty shocking article. It states that as of last fall, the average successful applicant for a Fannie Mae-backed mortgage, which is now the typical loan that's available, had a FICO score of nothing short of a stellar 769. So when you think about it, FHA loans, you need a 640. Some lenders can go to a 620. I know if you're located in our state and you're trying to get a 100% loan, for example, through Utah Housing, you need a 660 credit score. But a stellar 769, that's a phenomenally high credit score. What's more interesting is the average applicant that was denied a mortgage had a respectable credit score of 734. So here's a bunch of people with 734 credit scores that can't even buy a home. And so we don't want these 43 million people out of our marketplace. We want them out buying homes from us. Now, over the course of your lifetime, less than excellent credit could cost you anywhere from $200,000 up to $1 million in interest and additional fees. And what the credit reporting agencies consider good credit is 750 to 850. Once a person's over that 750 threshold, that's typically where they get the very best interest rates, terms, and conditions. And a good example of that is, let's say today that Eric wants to go out and he wants to buy a brand new Audi, because those new Audis, those A8s, they're sweet. So Eric goes down to the Audi dealership and he rolls in, they pull his credit, and his credit score is an 805. So Eric gets a huge discount on the car. He also gets the rebate. He gets the 1.9% interest rate. He gets a 72-month term, and they fill it up with gas, and he rolls out the door. He gets a phenomenal insurance rate on the car because he has a phenomenal credit score. Now, let's say that I've had some bumps in the road, but I'm making great money. I roll in that same Audi dealership, and my credit score is 500. Well, the auto dealer looks at me a much different light. I'm not going to get the same deal that Eric got on the car. In fact, they're probably going to sell me the car at full price. I'm not going to get the rebate. I'm going to pay a much higher interest rate. I'm not going to get the 72-month term, and they're not going to fill my car up with gas because they don't feel like they have to. And at the end of the day, my auto insurance rates could actually be as much as 143% higher than Eric's because of my less than perfect credit. So in that scenario, Eric's car payment could easily be $300 less per month than my payment. So you could see quickly over the course of the term of that loan how much more money it could cost me by having that lower credit score. And I no longer personally refer to banks as creditors. In my opinion, banks are in the fee collection business. If if you don't believe me, bounce a check, and you'll see what happens, because they'll start collecting, right? But in my opinion, banks now are considered predators, because when you think about a predator, you think about a lion in the jungle, and they prey on the weak, and those are the ones that they really kill and eat. And in reality, that's what happens when a person has a lower credit score. Is now that creditor, they can charge them those higher interest rates. They can cut their terms. They have control, because they know that that individual may be much more desperate to get into the home, or to get into the car, or to get the job. And so just keep that in mind when you're talking to your consumers about credit. About 80% of all credit reports have errors on them, causing lower credit scores. About 83 million people don't even know what their credit score is or what's currently on their credit report, and I hear this all the time. I heard this from my friend that found out that they had that judgment on their credit for the TV, because they went to buy a car, and the auto dealer was the messenger. They were the bearer of the bad news. You can't get a car. You got an open judgment. I don't have a judgment. Well, look, here's your credit report. You got a judgment. So credit is changing every month. Identity theft is the #1 white-collar crime in America. Every 3 seconds an identity is stolen. And so just since the time we've been on this webinar today, there's been lots of individuals that have been affected by identity theft. Myself personally, I've had my identity stolen 4 times in the last 16 months. Now keep in mind, most people stealing identities don't steal people's identities that have less than perfect credit, because they can't get more credit. Although they do steal their identities to do other stuff with it, even if they do have less than perfect credit, usually individuals with higher credit scores become greater targets. So today, just for being on today's webinar, everybody can go to annualcreditreport.com. You get a free credit report from all 3 of the credit reporting agencies every year. So simply go there, but when you go there, don't pull all 3 of your credit reports at one time. Now, they're all going to have different reporting algorithms. They're all going to have different scores. They're all going to look different, but you want to stagger those and go back every 4 months and re-pull a different credit report from the different credit reporting agencies, so you're seeing at least what's on your credit every quarter or every 90 days. Now, when you go to annualcreditreport.com, they are not going to give you your credit score. If you want to know what your credit score is, you can actually go to creditkarma.com and you just have to purchase your score. Now, I had a client that we were working with that when they entered our program, their FICO score from the Fair Isaac company was a 472. And their goal was to get back into home ownership. They'd done a short sale on 2 of their properties. One was their primary residence, their other was their secondary residence. Over the course of about a 16-month period of time, this individual went from a 472 credit score to a 760 credit score. So they changed dramatically in a short period of time. About 43% of employers use credit scores as a factor in determining who they're going to hire and sometimes promote. And this is a very scary thing. We had a short sale seller last year that was selling their home in Logan, Utah, right up where Eric is. And they worked for a credit union that's a statewide credit union. And their boss at this credit union, they were simply going to relocate to Salt Lake City. And when they did that, they were going to just transfer from the credit union branch that they were at to another credit union. Well, their boss told them while they were going through the short sale process, if your creditor reports your short sale on your credit as a foreclosure, we're going to have to fire you. Now, this person had been with this credit union 13 years, and the stress of the short sale is always enough to typically push people over the edge. But now this individual also had the burden of having to think whether or not they were going to lose their job if the creditor didn't report their short sale correctly on their credit. Credit affects how much you're going to pay in the interest for a mortgage, credit card, security deposit. I mentioned just how much it affects your auto insurance premium. In fact, we had a client in New York City. We lowered their auto insurance premium $2,000 a year. I had no idea how expensive auto insurance was in New York until they enrolled in our program, but they had very low credit scores, and as their credit scores went up over 750, their auto insurance followed it. Credit affects marriages, it affects self-esteem, stresses people out. I think that's actually one of the biggest anxieties for our home buyers when they buy a property is, am I going to qualify for my loan? And I still think that's the anxiety they have until they actually get the keys to their property. And credit also affects a person's financial freedom. It really limits them to what they can do. In fact, I recently flew down to our California office, and when I was there, I went to rent a car from Advantage Rent-A-Car. And Advantage Rent-A-Car pulls people's credit to determine whether or not they're even going to rent them a car if they're using a debit card. There were 2 people standing in line in front of me. I was about 10 people deep that were denied a rental car because of their credit, and they had to go over and rent from Fox. So people don't even think about those kind of things. So I know the people that were in front of me, they were embarrassed. They felt ashamed. They were powerless. People with less than perfect credit feel overwhelmed. And in a lot of cases, people feel like they have no hope, especially our short sale sellers. They're coming out of these short sales. A lot of these individuals, they don't have any hope. A lot of it gets to the point where we've had clients in the past take their own lives because of the stress that's caused by these types of transactions. Oftentimes in the CE classes that I instruct, I joke around about taking my real estate business card and removing my title as real estate broker and putting real estate psychologist on my card, because almost everybody that I talk to, especially when we're dealing with short sale sellers, they're in trouble. I look at my office at Equity Real Estate as an emergency room for sick homeowners or potential home buyers, because everybody that's typically coming in the door right now has some type of challenge. They've either fallen down and had some bumps and bruises, or even worse, it looks like they may have been hit by a train. So really, what can be done about what we do, and really the key is education. Our goal is to educate consumers to get them back on the road to recovery as quickly as possible. Just being on this webinar today, you're going to know a lot more about how credit works and how you can improve credit. And we believe that credit awareness is really on the rise. and it's almost impossible now to watch TV and not see an advertisement about credit. Even Experian, TransUnion, and Equifax, the 3 credit reporting agencies, all promote credit monitoring systems with a monthly fee and charge for that because that's revenue for these billion-dollar privately held companies. But going even this morning, I think I counted on my radio station 3 auto dealers talking about credit between my home and the office, which is only about a 5-minute drive. But that's prime drive time, so that's when they're advertising. I learned a few years ago when I was driving down our main freeway corridor, there were these big billboards from one of the largest home builders in Utah that said, "We fix credit." And I reached out to this home builder and I said, how's this program really working for you? And they said, well, we put 80 people in new homes last year that never would have qualified if we hadn't helped them restore their credit. And they were using a company that was very, very expensive, didn't make financial or physical sense for my clients. But I thought, that home builder is stealing my clients. So rather than, try and beat them, I was going to join them and compete with them. And so that's what I really did with my business. So before we share with you exactly how to take these individuals back into the home ownership process, and I promise you we'll get our webinar done today right on schedule, I just want to talk about the length of time the items actually stay on a person's credit report. So bankruptcies, whether it's a Chapter 7, 11, or a 13, they're going to remain on a person's credit report for 10 years. Collections, they remain on a person's credit report for 7 years. Public records, they remain for 10 years. Inquiries, 2 years. Check systems for banks are 5 years. Telechecks for merchants are 5 years. And scans for merchants are 5 years. And all of these are regulated through the Federal Trade Commission and through the Fair Credit Reporting Act. Now, there are different types of credit reports out there. For example, a mortgage lender may use a mortgage report where a person goes to an auto dealership and they may use what's called an auto score. If you go to a property management company and try and rent an apartment, the score or the credit report that they pull may be different than the other two. So just understand that what the creditors purchase from the credit reporting agencies can also be very different. One of the things, or a few of the things that we counsel our clients when we're talking about collections, judgments, and liens is don't be too quick to pay an old collection account, because depending on how old that collection account is, it may no longer be verified or verifiable. It may no longer be valid. There was a company here locally. We had an individual come in, we pulled their credit, and the creditor that was showing a repossession on their credit report for an automobile that they had purchased, that was an easy item to dispute because the creditor that had reported that was no longer in business. So when that was disputed, when the credit reporting agency reached out to the creditor, there was no creditor to reach out to any longer. They never even responded. So that item, even though the person legitimately had a repossession on their automobile 4 years ago, came right off their credit report within 45 days. We want all the judgments to reflect as satisfied after they've been paid, not settled. We also want collections to reflect as paid and paid as agreed. We also want liens to reflect as released when paid. Currently, I have a client right now that has some tax liens. Those have been completely removed from their credit report, even though they're still actually paying a monthly payment to the IRS because they've done an offer, settlement, and a compromise on some past due taxes. Now, credit reporting agencies, again, they're privately held billion-dollar companies. They don't verify any items placed on a person's credit report at all because they don't get paid to do that. They pay fines each year for failing to update credit files correctly because they make more money by not having to do their due diligence and pay people to actually verify information. They'd rather pay the fine and get slapped on the hand. Kind of reminds you of some of our banks out in the marketplace recently. Robo-signing, maybe ring a bell to anybody. And credit reporting agencies don't make money correcting credit. Again, they make money selling the credit files to big industries. So I suggest that everybody download the Fair Credit Reporting Act and read it if you have trouble sleeping at night. That's a great thing to read because it's not very sexy by any means, but everybody really needs to understand their rights when it comes to credit. Now, I did mention that you can restore your score. The Fair Credit Reporting Act gives Americans the right to dispute and or investigate any item on their credit report, even if it's being reported correctly. However, inaccurate, erroneous, obsolete, late payments, charge-offs, foreclosures, judgments, repossessions, bankruptcies, tax liens, collections, short sales, medical bills, and many other items can be removed from a person's credit file, or they can be updated to reflect as paid as agreed, even if at some point in time they were past due or being reported otherwise. Just a few of the Fair Credit of the Fair Isaac Company facts. FICO measures whether a person is moving towards or away from bankruptcy. That's what they're really looking for. A lot of Americans right now are redlining, just like a car. They're at the very top of their RPMs on their financial engine, and really, you know, if they could pop over the top and implode at any time. Scores are damaged by the most recent reported derogatory information. So if a person has a recent late payment because maybe they went into default to do a short sale, that's going to affect their score more than if that item was 4 or 5 years old. Derogatory information reported prior to 2 years will still impact a person's credit score, just might not be as dramatic. And the interesting thing about the Fair Isaac Company, when we talk about algorithms and how things get reported on their credit, FICO has 88 negative rating factors and only 5 positive rating factors. So the system, in the way that it's set up, it was set up for failure right from the very beginning. So here are the Fair Isaac Company scoring factors that you can control. You can control 35% of your payment history affects your credit, 30% of the amounts that you owe affect your credit, 15% of your credit history, 10% of new credit, and then 10% of the numbers and types of credit cards that you use affect your credit score. Now, higher FICO scores helps consumers obtain loans faster. Credit decisions are fairer. Older credit problems count for less. Again, that's great for bankruptcies. If a person's been through that, they have more available credit. Credit rates are lower overall. And with an understanding of how the system works, a person can really improve his or her credit rating from a D to an A. Now, the company that we work with is United Credit Education Services. You can go to their website. Their domain name is united-credit.org. This is an informational website, and this is a sample copy of it right here. On the top right-hand corner, there's a video. If you click on that video tab, it's about 8 minutes long. It's just going to share a ton of information about credit for consumers, how they can protect themselves, how they can enact the Fair Credit Reporting Act to get these items removed from their credit, and how all the services work. Once a person becomes a client with United Credit Education Services, they can log into their 24-hour information portal, which is also awesome for your preferred lending partner, because your preferred lending partner can log into this same portal and monitor their progress so they know when to repull credit and credit qualify them. When an individual enrolls in the program and verifies their identity, United Credit Education Services is going to pull their credit. They're going to post their initial FICO score, show them right where they're at. They're going to have some important document downloads that are available to them, like the creditor's harassment letter and debt validation letter that a person can print off and send in to those creditors to stop the collection calls. Also, they're going to pull all 3 of their credit reports and they're going to post them in their 24-hour information center. It's going to show what accounts have been deleted, what accounts have been verified, and what accounts are still in dispute. United Credit Education Services, they're a nationwide company. They've been in business for over 10 years. They have an A+ rating with the Better Business Bureau. They've served over 160,000 clients, removed over 600,000 derogatory items from people's credit reports, as well as removed over 60,000 public records, and they have a satisfaction money-back guarantee, which was really important for me and my clients because I needed to feel comfortable referring my clients to a company that I was not only confident in, but if this company didn't do their job, then my clients were going to get their money back through their 100% satisfaction guarantee. Now, this morning I jumped on their website. I pulled their success rate as of today, which is 6/20/2013. they've removed 153,233 late payments, 411,961 collections, 69,997 public records, and they've corrected 25,897 personal information records for a total of 661,088 total items corrected on individuals' credit reports. So I know a big question that I always get is how much does this cost? And I'm not, sure how familiar you are with companies in this industry, but there are individuals out there and other companies that charge fees, believe it or not, in excess of $5,000. I actually know of a person that paid a law firm $10,000 to fix her credit. They didn't fix their credit, but they sure fixed them. So United Credit Education Services, we don't even charge $1,000. In fact, it's actually half of that. Our annual program, which is 1 year's worth of service, it's 5 rounds of letters with all 3 of the credit reporting agencies, regardless of the number of derogatory items on their credit. It's a $499 investment for a consumer, and that comes with 100% satisfaction money back guarantee. But because Equity is such a powerhouse and we have so many phenomenal agents and we realize the value in this program, United Credit Education Services has agreed to provide our agents, because I know everybody on the webinar, I'm sure, has an 850 credit score. And some of you probably just chuckled because that was kind of meant to be funny. But if you're an agent, you've been through some bumps in the road, if you need the service for yourself, you can take advantage of this. Your friends, your family members, your potential home buyers, your short sale sellers, you can enroll your clients and they can save $100 off their annual enrollment. You simply need to use the promo code ILOVEEquity. And they're still going to receive the 100% satisfaction money back guarantee. And so phenomenal opportunity for your clients to take advantage of this program. Now personally, I enroll my potential home buyers and sellers in this program all the time. I have a huge pipeline of people that just pop out every single month that are either ready to buy a home now or will be purchasing homes in a short time down the road. And so the big question is, how long does that seller have to wait from the time when they do a short sale in order to get back into home ownership? Well, if they're in California, Oregon, Washington, Arizona, Utah, Colorado, soon to be Nevada, soon to be Florida, these individuals can get a loan 1 day after the short sale closes through a portfolio program. If you have clients that you want to pass this information along to, I will give you my contact information here shortly in the next couple slides. You can simply email my office and I'll email you the current contacts that we have for these types of portfolio programs. There's no waiting period. The only caveat is a default can't be reported. If a default has been reported, that's okay. It can still show that a person did a short sale. We just have to go in and dispute that they were ever late and just get it to show paid with no late payments or settled for amount less than owed with no late payments, and they can still do their loan. It's up to an 80% loan to value. It's a conventional term, and rates are only 1 to 2% above current market rate. Now, with most traditional lenders and credit unions, an individual is going to have to wait 2 to 3 years before they can get a loan. However, ask your local lenders, ask your local credit unions what type of programs that they have. There's a credit union here where I'm located in Salt Lake City that they have done loans for some of my clients as little as 6 months post short sale. The key to this whole program, though, is to get your client into a recovery program as quickly as possible, at least one of the programs that we discussed at the beginning of the webinar. Now, we do have a financial literacy challenge that your consumers, your clients, your customers can take, as well as we suggest that you take it as well to see where you stand. Because we ask people every day, are you financially literate and responsible? Are you protecting yourself and your family? Do you have peace of mind? And the best way to find out is just go to fesliteracychallenge.com, take the challenge online, and find out for yourself. In addition to that, when you're talking to your potential buyers or your sellers about credit, we don't expect you to remember everything that you learned on this webinar today, although we are going to email it out to everybody so that you have a copy of it. You can always go to ucsinfo.org. You can watch the short video that it really explains what we do and how we do it. And before I just give everybody all my contact information, answer any questions anybody might have, today's message is intended for everyone. If you have a low credit score, you have a legal right to do something about it. The only reason that I can think that somebody would accept bad credit is that they're unaware that they can actually change it. And once they know that they can and they still don't, that's kind of on them. It's kind of like having a sickness or a disease and never going to the doctor. If you never go, you never get better. Credit's the same way. If you never do anything about it, it doesn't change. So the longer you wait, the longer you wait. United Credit Education Services does 95% of the work. 95% of the work. Last year, in 2012, approximately 19,000 people across the country used our service. 100% of them that followed our simple process had an increase in their credit score. Our program's inexpensive. We have an A+ rating with the Better Business Bureau. Again, comes with that money-back guarantee, and we produce fast results. In as little as 45 to 60 days, we can take somebody that may have, a 613 credit score, shoot them up into the 750s. You just don't know until they get into the program. So today's webinar is not a sales pitch. It's simply a solution to a very expensive problem. Just a reminder about our unique value proposition. If you really want to know how to implement this, you're welcome to call my office. I'm happy to explain it to you. On the screen is my contact information. As Eric mentioned, I'm located right in the Equity Corporate Office. You can call us toll-free, 1-800-480-1917, extension 0. Now, this doesn't just apply to credit. This is also our short sale hotline. If you're struggling on a short sale, if you need a contact at a lender and you don't know where to turn, if you have a creditor that you want to know information about, if you have a silent second because somebody did a loan modification and it was sold and you don't know where to turn, call my office because we can point you in the right direction. 1-800-480-1917, extension 0. You can email us at ucesorg@gmail.com. And again, you can visit our website at ucesinfo.org. So Eric, are there any remaining questions out there that we want to address before we wrap up today?
Yes. First, I want to thank you, Randy, for your time and the details here. I know I took a lot of notes. Hopefully you guys attending did as well. I'm always learning new things from Randy. He's one of our local experts, and it's great to have him with us. A couple of questions that I think are pertinent, and for all of you that did type in questions, I appreciate it. Some of them are very personal, it looks like. Maybe not something that would appeal to everybody, so please take down Randy's contact information here because some of these would better be addressed to him on a personal level rather than on a webinar for a whole bunch of people. So a couple of the ones that stood out for me are, do you get paid anything for referring people over?
That's a great question. We do have two options available for our agents because we're not regulated by RESPA. Yes, if you want to refer your clients to us, we will pay a referral fee. Obviously, because we're providing a discount of our service from $4.99 to $3.99, the referral at $3.99 is less than the referral at $4.99. We do have an agent affiliate program available. If you would like to learn about our agent affiliate program, you can just go to agentaffiliate.com and you can find all that information online, and then just call our office, and I'm happy to answer any questions that you may have about our program.
Thank you. The other question I thought on here was appropriate. When you enroll, like a couple, say, does the fee count for both the husband and the wife, or do they have to pay separately?
They would have to pay separately because credit is based on a per Social Security number basis, and a husband or spouse or significant other may have something different being reported on the other person's credit. We just had that happen where a husband and wife that had done a short sale on one credit report, they're reporting it as a foreclosure. On the other one, they're reporting it as a short sale. And okay. So same people, different outcome, which was really bizarre. But that's kind of how credit works. Sometimes it just doesn't make any sense. Now, one thing that we can do for couples, because oftentimes a $798 investment for somebody may be a little difficult, we can actually split that into 2 payments. So we could get both individuals started right away for one payment of $400 for both of them, and then an additional payment 30 days later for $420, which would be the remaining balance for both of them. But the nice part is we're going to start working on their credit right away. So we've actually had people have their credit score increase before they even made their second payment.
Awesome. Randy, the rest of the questions on here were fairly personal for situations, specific situations that I think would probably be better asked in person. So I think we can go ahead and wrap it up here. Again, I want to thank you for your time. I'm going to be contacting you later today as well. So thanks everybody for joining us today. Thanks Randy for your time. We'll see you guys all online next week.